following is a Silver Bullion television audiocast. Hello everyone, and welcome again to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Today we're very honored to have John Williams on the show. John has been a private consulting economist and a specialist in government economic reporting for more than 30 years. His early work in economic reporting led to front-page stories in the New York Times and Investors Business Daily. During his career as a consulting economist, John has worked with individuals as well as Fortune 500 companies. He's also the founder of the website Shadow Government Statistics, more popularly known as Shadow Stats. Good day, John. How are you? And welcome to SBTV.
Fine, thanks, Patrick. Thank you for having me on your show.
Thank you for accepting, John. We really appreciate it. John, your work at Shadow Stats is very well known, especially to those of us in the precious metals industry. When we needed M3 money supply data, your website would be the go-to site to obtain this data since the Fed ceased publishing it back in 2006. We'll get back to M3 a little bit later, but for now, could you let us know what got you started looking into the real numbers of the economy, and what was your motivation to track the real economic data and make it known to the public?
Well, I've been a consulting economist for 35 years or so. Mm-hmm. And as I got into the trade, and initially I'd cut my teeth in the currency markets. I'd been in the import business here, and first day on the job, Richard Nixon floated the dollar.
Oh, no.
So I had to. I became a currency trader very quickly, and the background in economics, it's just a happy confluence of things that eventually led me into being a consulting economist. I'd seen a lot that could be done with econometric modeling, where you can use all sorts of statistical techniques to try and model what's happening in the economy based on other factors, and where you have grand scale models of the U.S. economy that had been built at the time and are still used by the U.S. government and the Federal Reserve. They're never very good at forecasting the future. Reason being is that let's say you wanted to forecast what interest rates were going to be doing next year. To do that, you first had to estimate what the rate of inflation was going to be, and then you'd plug that into their formula. If you knew what the rate of inflation was going to be, you really didn't need a model to tell you where interest rates were going. At least that's the way it used to work. And I got into modeling the economy and interest rates using only leading indicators, where you had actual numbers in hand, and you might have a lead time of maybe 3 months with certain numbers and 6 months with other numbers. And that worked pretty well. You could actually get the direction of interest rates, turning points with a fair degree of accuracy. But then as you got into the latter part of the 80s, things began to fall apart. And the reason was that the government was changing the way it reported its numbers, right. such as inflation, such as the GDP, and I found I had to look at that very carefully. And the changes, as you might expect, tended to make inflation look better than it actually was. Right. That the GDP would look better, and I found that a few people realized what was happening there. So I looked to come up with alternative measures on those factors, the inflation, the GDP, unemployment, done the same way that they used to do it, or at least trying to estimate the differences, so that you had a consistent measure over time.
Right. Was this during Ronald Reagan's era or Bush's era?
It pretty much was. Some of it started with Reagan, but it's mostly in the Bush era, mm-hmm. and the Clinton era. Yeah, that's when you had big changes. I mean, if Bill Clinton had a the President of the United States always puts out an annual economic report of the President. Mm-hmm. And the last one he put out, he was boasting about how the GDP growth was picking up because they changed the way they calculated inflation.
Oh.
And the way that worked, very simply, the way economists look at the economy, it's not in the current dollars. What are you actually paying in today's dollars? But it's adjusted for inflation. Let's say you look at retail sales, for example, and your retail sales are up 5% year over year. Well, that sounds pretty good, but what if inflation is up 5% year over year, and what you're seeing in your retail sales growth is just inflation, that your sales are not picking up in physical volume.
Right.
So that's why people like to look at the numbers net of inflation, and the gross domestic product, which is now the broadest measure of the economy. It's all inflation adjusted. Well, the nice thing, and this is why some of the games were played with inflation, is that if you understate the rate of inflation that you're using to deflate the numbers, you tend to overstate the inflation adjusted growth. And right now, I'll contend that the GDP reporting is deflated using a rate of inflation, and this is different than the CPI, that's understated by about 2 percentage points. And what you see is that if you correct for that, we really have never recovered from the 2007 recession. The economy's been stagnant, just bouncing along. This is the U.S. economy.
Right. Excuse me. I believe on your sorry about that. On your website, Shadow Stats, you show 2 charts of consumer inflation. One chart shows the official versus 1990 based alternate, while the other shows the official versus a 1980 based alternate. So I guess we're back to Mr. Reagan again.
Yes.
As our listeners may not be economists, could you explain the significance of using the data from 1990 and 1980 as alternate estimates for today's consumer inflation?
Sure. The concept of a consumer price index, which measures inflation, used to be just measuring the cost of maintaining a constant standard of living. That's been around literally for centuries. And the concept simply was to measure a fixed package of goods in value and price one year, and then measure the same package the next year, and whatever the change in the value of the package, that was how much inflation went up. That's how much your hopefully your income would rise, at least, so that you could maintain a constant standard of living. The early 1990s, Alan Greenspan and the Bush and then Clinton administrations got into monkeying with that. But back in the 1980s, and this was without any big to-do, the government started to change the way they measured the price of goods, where the costs were not really hard measurements, but were effectively modeled by computers for quality changes that you couldn't measure in hard dollar terms, but computers could estimate. Well, if you can't come up with a hard estimate, guess what? The average guy usually doesn't recognize that.
Right.
And I'll give you an example. There was a reformulation of gasoline in the United States some time ago, aimed at improving air quality. Mm-hmm. And when that went into effect, it increased the price of gasoline in the United States by 10 cents per gallon, which was a big increase at the time. But they didn't count it in the consumer price index, which is the measure of inflation, because it was deemed a quality improvement. But I can tell you that the average guy, when he was driving to work and pumping gas into his car, noting that he was paying a lot more in the way of for his gasoline, that he wasn't saying, "Oh boy, I'm getting better quality air." He was moaning and groaning that it was costing him more to go to work.
Right.
And that's there's a whole series of hedonic quality adjustments there that they put into the system, which understates the pace of inflation. The Again, not there wasn't a big hoopla over that. It was just done very quietly. But in the 90s, the issue was um, substitution. As Alan Greenspan pointed it out, he claimed, well, the consumer price index is inaccurate. It's a matter of definition.
Mm.
The way he wanted to define it was without people substituting, or was with people substituting goods when something got more expensive. The example he'd use is, well, let's say the price of steak rises and gets too expensive, people will buy more hamburger, or they'll buy more chicken. And while from a practical standpoint that might be what they do, if you're looking at the consumer price index as a way of measuring your cost of living, what your income has to go up by in order to maintain a constant standard of living, substituting chicken for steak is not maintaining a constant standard of living. And so what they did was they made all sorts of adjustments to the weighting of goods. They went to what they effectively they didn't even they couldn't even change the CPI to do that accurately. So they made mathematical gimmicks in there in the way they had geometric weightings with goods that had the effect of reducing the headline consumer price index. At the same time, they introduced a new consumer price index called the chain-weighted consumer price index, which was fully substitution based. And every change it made knocked down the rate of inflation. Well, why were they doing this? As Greenspan explained it, and also Newt Gingrich at the time, who was the Speaker of the House of Representatives.
Right.
It was to help contain the budget deficit, because they could reduce the cost of living adjustments that they were making in terms of paying out Social Security benefits. And the way the tax system works, they could boost people into higher tax brackets artificially and collect more taxes from them. Which just to me is garbage, because it's just bad politics. They're afraid to approach the people and say, look, we've got to balance the budget here, so we're going to do it by subterfuge, and we're going to give you too low an inflation rate and underpay you for the cost of living adjustment you think you're getting, or that you should get, or we're going to artificially boost you in taxes there to increase our revenues. Why not just be honest with the people and work it that way? Here's where it gets really bad. Aside from what the government's doing effectively to steal money from the public, most people in the United States will rely upon the government's inflation number as being accurate.
Right.
Because I know many landlords, for example, use the consumer price index for raising rents. And a lot of people who work in the private sector, their companies often will base regular pay raises on the consumer price index. Now, back before they started playing games with us, that wasn't too bad an idea. At least you had some way of adjusting for inflation. But right now, they're using too low an inflation rate, so people are not, their incomes generally are not keeping up with inflation. That's one of the problems with the economy. Landlords are not getting adequate rent. And you mentioned the 1990 and the 1980 indices. What I did, and the Bureau of Labor Statistics is generally pretty open about what it does here. They'll publish what they're doing and what they think the effect will be. I just took the effects that they were making here and what they estimated the changes would be in the annual CPI inflation, and I've added it back in. And if you go back to 1990, all the changes are order of magnitude 7 percentage points, which puts you up in the 9-10% range. in terms of if you were looking at prices as they were viewed in the 1970s, but before all these games started. And 1990, which is when they formally started altering the CPI to cut the budget, there the difference is closer to 3.5 percentage points. So I show it both ways, but the point is it's a significant difference. People in the United States we're living on the government's based on the government's consumer price index are not covering their cost of living increases.
Yeah, I'm not even in the U.S. right now, but this kind of news. Yeah, it can be pretty upsetting. It can start to get the blood to boil. But this inflation, why does the Fed choose this 2% inflation target? Why does this seem to be a magical number?
It's nonsense. It's a canard. It's a charade by the Fed. They're major participants here in terms of artificially creating the inflation rates that we have today. My contention with the Fed, very simply, is that they don't know what they're doing. They have no way out of a panic here. And they've been in a panic since the banking collapse back in 2008. The system was collapsing.
Right.
U.S. banks, major banks were failing. We were in a day or two of a system collapse. So what they did was everything. And it's not just the Fed. It was the Fed and the Treasury and central banks around the world were all trying to cooperate. They did whatever they had to do to bail out whatever had to be bailed out, to guarantee whatever funds were in the system, debts, so that the system would not collapse. Having the system collapse was not a viable option.
Have we learned anything since that time, or nothing really has been solved?
My contention is that the system collapsed then, and we're still in a state of collapse. We just haven't fully figured it out yet. The Fed hasn't quite figured out how. They're trying to exit now, but the banks still are not lending normally in the United States, and all the things they did with the banks was to save the banking system, not to stimulate the economy. So that the economy did suffer because of all these steps to save the banks. I think in some cases they might have done better just to scrap the existing banking system and start with a fresh system, reorganize the system, as opposed to just bailing it out. The quantitative easing that they went through,
right? Yeah,
and trying to get out. That's why they keep talking that 2%. It's not. The 2% has nothing to do with what they want to do. That's the face they put forward to the public. The official story from the Fed is, we have a mandate from Congress to contain inflation and make sure the economy continues to grow. Well, that's true. But their primary function in life always has been to keep the banking system from collapsing, to keep it afloat. They're owned by the banks. And so what they did to save the banks, the quantitative easing, was all aimed at providing liquidity to the banks, not to stimulate the economy. It was to keep the banking system afloat. If they wanted to stimulate the economy, when they they gave all the banks all this cash buying up their bad mortgage debts and such, and treasuries, which were in theory not in trouble. That's the way they normally would stimulate money growth. But instead of letting the banks lend that money into the commercial system, which would have increased the money supply and stimulated the economy some, they pulled it all back into the Fed. They said, you've got to deposit it with us as excess reserves. We'll pay you interest on it, which they did. So that they took whatever steps they had to make sure the banks remained liquid and solvent, and didn't let it get into the economy, which would have helped the average guy more. And it's still not right. They're still trying to work it out.
Yeah, I've always, in my own little simple mind, I've always felt that Maybe back then they should have had some sort of a helicopter drop and given money to the people to perhaps pay off their mortgage or whatever else may have been on their books to get money back into the system and pick up the velocity.
Yeah, that's we're going to have a helicopter drop. Why not do it with the people who can use it as opposed to just saving the banks?
Sure.
I mean, got nothing against banks, but it was the public and the economy was held hostage to preserving the existing banking system. And well, there are big pluses, I presume, in that happening. The way they presented it to the public was an outright fraud because they were not trying to stimulate the economy. And whether or not they could get, here's where you have a big problem going forward. Because if they're saying, oh, we got the economy growing again and everything's fine, so we can raise interest rates. And they're saying, well, one good signal of the economy being normal would be inflation getting back above 2%. Well, the way they've gimmicked the inflation is going to be difficult for that to happen as they're looking at it. In reality, it's much higher. But that's an artificial target they're using to try and placate the markets. But the problem remains is that the U.S. economy never has really fully recovered. It's looking strong now, and we had some big boosts in the last quarter or two from the terrible hurricanes and wildfires in the United States, where you had a lot of recovery and insurance payments and such, people buying houses and cars that were destroyed or rebuilding, and that boosted the economy some. But you look at the broad economy, you look at the money supply growth, and I measure the old M3 the way they used to. They stopped reporting that back in 2006. It's a very good predictor of broad economic activity when you adjust for inflation. And if you use your headline inflation number, which is understated, and so it overstates the growth in the money supply. We're seeing levels here that are consistent with the economy falling into recession again, not booming along. And again, I'll contend we've never really fully recovered here.
Yeah.
But as the economy slows down, and it is going to slow down, the Fed, when you read their minutes, they allow that they can go back with more quantitative easing. They still don't have the system intact, and they're going to have to move back towards that quantitative easing. And as they do that, it's been the movement away from the quantitative easing has been part of the hype for boosting the dollar, keeping foreign funds in the U.S. dollar. And as they start to move back there, as people begin to recognize this economy is not quite as advertised, you're going to see very heavy selling against the U.S. dollar. That's going to be very inflationary for the United States. And it's going to, as the Fed actually moves back towards that quantitative easing, you're going to see a big response as the dollar sells off in terms of the precious metals, gold and silver. They're your best bets against what's going to become a very bad inflationary environment. It's over millennia has been a store of wealth.
I agree. It is a store of value. Probably within the last 5 to, let's say, 10 years, I think we've seen more people in the precious metals industry or the investors. They've seen it more as an insurance now. And they're still quite happy that they have an investment / insurance for what's about to come. But getting back to the U.S. dollar, I think probably the biggest thing that the U.S. exports right now is inflation. I see it here in Singapore and other countries. They see it, and when that dollar does sell off, that inflation is going to go right back to the U.S.
Yep, you're right. It's a major problem. And let me put it this way. Interesting thing I have found is that if you look at over the decades, I go back, and again, I use U.S. numbers here. Mm-hmm. If you go back to 1900, and this is very rough approximation, but let's say you had $100 in 1900, mm-hmm. and you just left it in U.S. dollars, You didn't invest it in anything. It'd be worth 20 cents today.
Yeah, right.
That's just on the headline uh, inflation. Uh, if you put your money in gold, um, I think you'd be up around $200, something like that. It may be more than that in today's dollars. It's Gold has preserved the purchasing power of the dollar over time, and in fact, if you look at it against my estimate of inflation, it's actually basically covered my estimate of inflation.
Oh,
So it is the uh, it indeed preserves the purchasing power of one's wealth and assets over time. Now, you may say, "Well, my goodness, I'd expect maybe if I put my money in gold, I'd have more than $200." But guess what? It's not only preserved the value, it's actually increased them. And that's that 200. That's against my inflation. So it does what is advertised. And if you buy the government's numbers, you're making a lot of money with it too. But it preserves your wealth and assets from debasement through all the monetary games and such that governments play and inflation that you see.
right. I remember. I think it was a couple of years back. People in the States, they were fighting to get, I believe, a $15 minimum wage. Now, yeah, the thing is, had the government kept 90% silver coins, pre-65 coins, half dollars especially, you would only need $1.50 of, or three $half-dollar coins, which by calculating the silver value would have been worth over $15. So had they not debased the money and kept the silver in it, or perhaps even kept the gold in it, it would have steadied with inflation, and in fact, they would have fought inflation off.
Yep, I can't argue. That's right.
We do have some people, they will say, why do you buy gold and silver, and they don't quite understand that it's a store of value, it's insurance, and they're only looking at the investment side of things.
Well, let me put it this way: if you look at the S&P 500, widely followed index in the United States, stock index in the United States, have what they call a total return index, where you get to reinvest the dividends, so that the index there reflects you receive all of the dividends and you reinvest them in the S&P 500. If you go back to 2000, which I think is about when they started that, I've just used 2000 artificially, but if you look at gold as in its pure physical dollars per troy ounce value against the S&P 500 total return, gold has outperformed the S&P 500 over so far in this millennium. You have if you look at it net of inflation, and this is headline inflation, not my numbers. What you'll see is that the S&P 500 we go back to 2000, and the total return, it didn't really break above zero against inflation until 2013, where the gold has almost always been above the zero inflation point. I can't tell you exactly what numbers are going to go forward here, but I can tell you you're going to have a big problem with inflation over time. That's been the consistent issue over time in the Western economies, particularly the United States. Well, there are others that have been a lot worse, but I mean, it's guaranteed in the United States. So that the way I would look at it is that you take a certain portion of your assets and hold them in the precious metals. I personally, I look at holding the physical gold. I think we've got some very difficult times, physical gold and silver. and you got crazy political circumstances. You can never tell what's going to happen. But the prices will go up and down. The governments step in and manipulate the prices,
Yes.
but over time the prices prevail. I'm not into day-to-day trading on these things. I'm just saying you have an established hedge against the malpractice of governments on their economies and inflation with the precious metals. You hold it over time as a long-term hedge against what will otherwise debase your assets.
Yes, we hear from quite a few of our clients who do store with us in Singapore, where they say there's a time in your life where you make money, but then there's a time in your life where you protect what you made, and they start to get into wealth protection, and so they understand this, where the silver, the gold, precious metals, excuse me, things like that, it is going to store their wealth over time.
Well, if that's the case, then it's even with the ups and downs, and I sure wouldn't want to forecast where the stock market's going here.
Yeah.
It's what it tells you is that over time, you'll tend to make money with it, despite all the crisis. And again, you have people that you have national entities, you have central banks that don't like to see the precious metals rallying, because generally it tells people that the central banks are not doing their jobs. But there's no chance of they're doing that in the near future. I mean, they're doing their job, so it's not you have a pretty good bet against them.
Yeah, I'd have to agree with that. With President Trump, do you see it as a trade war going on, or just a trade adjustment?
I see it as a trade adjustment. I think you're just in the middle of a lot of negotiations. The reason that you're seeing it is that a lot of displaced workers are blaming the trade picture for the decline in their lifestyle, and that's why they voted for a change. It's a difficult circumstance, but you have all the theories of free trade are fine, except they miss one major point. The basic tenet there is that let's say you have two countries that aren't trading, and one country makes one product real efficiently, more so than another country, and that country makes another product more efficiently than the other, but they're not trading. If they open up trading, then you'll see some shifting of activity back and forth between them, and you're going to get more of both products made in both areas, so you have increased wealth and everything's just fine and dandy. The only problem with it is that there's an underlying assumption there that both economies are at full employment. And the U.S. hasn't been, and neither have its major trading partners. So the effect is that the trade tends to flow to the low-cost producer, the low-cost labor, and that's generally what's happening. And that's it's the nature of the nature of the beast. But they'll work it out. I think there's a rebalancing that'll come out of this, but that remains to be seen. I don't think we're going to end up in a trade war.
Okay, well that's that's a bit of good news. Going back, you mentioned QE a bit earlier. Why do you think the U.S. hasn't seen the hyperinflation yet, despite QE going on?
Well, they didn't let they didn't put the money into the economy. If they'd allowed the banks to lend the money into the system, you would have had a much stronger economy, and you would have had much higher inflation. But they didn't allow it. It's simple. They've kept the economy effectively in check. Whether that's deliberate or not remains to be seen. But you didn't get the money supply growth that would go with that.
Okay, and in 2006, you also mentioned that they stopped publishing the M3 money supply data. Why do you think they stopped publishing it? Was it for political reasons or something else?
I'm sure it was for political reasons, but there may have been something else there. The broader the measure, usually the better indicator it is of economic activity. The M3 has been stronger than M2 and M1, but now it's the patterns are beginning to reverse. It's slowing down, and that's in nominal terms. Of course, if you use actual inflation there, the things turn around a little bit, and we're seeing a very weak circumstance that would be consistent with deteriorating economic conditions. But the way I show it generally is as they use the headline inflation, because that's officially what the Fed's looking at. I think they still look at M3 internally. Yeah. And you'll see, just as a point of clarification, you'll see on certain websites an estimate of US M3 that comes out of the OECD. Mm-hmm. That is not M3. What they publish for comparing countries around the world is their broadest measure of money supply. So that what they put out there is US M3 is actually M2, which is the Fed's broadest measure of the money supply. But you have right now a pattern where, M3 generally has been weaker, but where M2 and M1 have been higher, they're now coming down to the M3 level. We're seeing what would traditionally be a slowing pattern that you'd see going into a recession. Last time you saw it, all three of those coming down was in the economic collapse.
Yeah, I remember back in 2014, Christine Lagarde from the IMF, and it's all over YouTube. She made a statement saying that there will have to be a global currency reset, and when that day will be, who knows? But for now, it looks to be a good idea to perhaps keep accumulating gold, prepare yourself for hyperinflation, and hope for the best, I suppose. What would you recommend for the average guy?
What you said is, I think that's about right. I mean, if you're trading gold day to day, and that's another game that people love to play, that's fine. It's like going to the casino and just don't bet money you can't lose. But if you're looking to preserve your wealth over time, and to have your wealth stable and actually growing some against what most people will be looking at, over time, the precious metals will hold you in that position.
John, I appreciate your time, but before we wrap up, could you tell our listeners how they can find out more about your work and as well as the benefits of your subscription service?
Sure. I have a website called shadowstats.com. And what I publish is a weekly commentary that's available by subscription, $175 a year, $89 for 6 months. You get it over the internet, but it's a nice printable document if you want it, or you can just read it electronically. There's also at the website shadowstats.com a great deal of background information on a lot of what we've talked about here today. A number of articles on the inflation matters, for example, and it shows you the plots of the different series that I work on. And if you look at the right-hand column, those are all free articles, general background. Left-hand column, those are the current commentaries. You can at least see the headlines on them. And you go back before 3 months, the archives are open for anyone who wants to look at it. So we welcome visitors, and of course, always welcome new subscribers.
I think the information you put out, it's definitely going to intrigue a lot of us. But again, I'd like to say thank you, John, for being here today. Economics is such a large field with diverse topics, and I hope to invite you on the show again to discuss other areas of it. It really was a pleasure speaking with you.
Well, again, thank you, Patrick, for having me. A great pleasure speaking with you.
Thank you also, John. Appreciate it. That was John Williams from shadowstats.com sharing with us about the real numbers to the U.S. unemployment, inflation rate, and money supply. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on our new content.